Did you ever hear that term, I'm stacking paper? You hear a lot of people, a lot of young guys say, I'm stacking paper, I'm stacking paper, I'm stacking paper, or I'm getting the bag. And what they're saying essentially is that they're earning income or they're accumulating cash and they're stacking it up, piling it up, piling it up. Money doesn't grow this way. Money grows this way. Basically, you want to diversify your money that you have. Don't take all your eggs and put them in one basket. It's true, but at the same time, don't compress your money. Number one, money is not real. Money is a spirit. Money, if you notice the last time you probably made a transaction, more than likely you used a credit card or debit card, or either you used an online banking system or Bitcoin or whatever you use. In other words, fiat cash, paper money is not the thing. And if you want to grow your money, you want to grow your fiat, you want to do what? You want to get interest, you want to compound your money. Take a little bit of money, let it go to work for you, and then the interest from that money will make your pile a lot bigger. So what I want to talk to you in this very brief video today is about generational wealth, tax-free generational wealth. So first of all, you want to think about getting a trust. So if you get a revocable living trust, then through that trust, you can set it up and you can structure it to have income for life. There are two ways you can do that. You can get, for example, an IUL, and I'll explain what that is, and or you can get an annuity. I'll also explain how that works as well. So, in an IUL, which is short for, is an acronym for Indexed Universal Life Insurance. And what do I mean by indexed? Index means it's in the stock market. That's just another term, index. That's all that is. So the IUL can create you tax-free retirement money. So once you retire, now you don't have to go to Walmart and stand up there and say, may I see your receipt? And use your little marker and your little highlighter and mark through the receipt. By the time you're at that age, 70, 80 years old, it's time now to be thinking about retirement. Sometimes our pockets or our bank account won't allow that. It misaligns with what we wish, what our wishes are. But this is a way, especially if you're still younger and you're in the accumulation phase, meaning you're still growing income, then you can put your money in a vehicle that will get you there or get you closer to where you want to be. So retirement, tax-free retirement income is one of the things. And then, of course, being an IUL is a life insurance policy, which means that it comes with a death benefit. Death benefit. It's required to have a death benefit in order to be a life insurance policy. So it's a glorified savings account is really what it is, and you're overpaying your life insurance. So if your life insurance costs you $100 a month and you put in $600 a month, then at least 500 is going into some type of way to make you money through the stock market. And there's a system, and I'm happy to break that down to you at a later time. So basically the retirement, the trust will purchase the IUL, right? And then it will take out tax-free loans, right? So if you need it, so then you have steady income. And you know that with a loan, you don't have to be taxed on the loan, but you do have to pay it back. But when you come into retirement, when you start taking those tax-free loans out, you're not going to pay them back. Now, you may have to structure that differently to where you have to start taking withdrawals up to a loan amount to be able to get the tax benefits, to get the best tax benefit. You can just take out a loan, but you may be able to take withdrawals as well up to the loan period, to loan point, so that you can get more money, okay? Now, I told you about the Indexed Universal Life Insurance. Now I want to talk to you about the annuity. So in an annuity, you can get a fixed index annuity, for example, and that's the one that I'm going to be talking about. So with the fixed index annuity, or you can get an immediate annuity, but either way it's still fixed index, right? You get an immediate or you can get it for deferred, right? But a fixed index annuity is when you have a fixed rate of interest. You pretty much know what it's going to be, right? As opposed to a variable annuity, it depends on the stock market, but it comes with a lot of other risk factors. So you could lose all of your money. Whereas with a fixed index annuity, you don't lose any money. You may not gain any money when the stock market is down in a bearish market, but when it is bullish, then now you're actually growing money, and that is in both. So an annuity does what? It guarantees income for the rest of your life. The trust will purchase an annuity, whether it's a fixed index annuity, whether it's immediate or whether it's for down the road. Well, let's just say it's an immediate annuity, and you want to start getting paid right away. So an annuity, that is it. An immediate annuity, it starts to pay you within 30 days, or you can get paid within 30 days. So let's say this would be for someone who wins the lottery and wins a significant amount of money. Rather than putting that money in the bank, you can put that money into an annuity. The money will continue to grow, continue to get interest, right, to compound the interest on that, but you are also getting paid off of it immediately. So you win $1,000,000. You put the $1,000,000 in the annuity, and you want to start getting money. You want to start getting $10,000 per year or $10,000 per month, whatever. So let's say you're getting $10,000 per year, then we know you guarantee income for the rest of your life. Now, if you need $100,000 per year, then how long do you think that's going to last? It's not going to last very long. So you can structure your payments for how you want them. So let's review. In Index Universal Life Insurance, that's what it guarantees you tax-free loans and cash accumulation value. And annuity does what? It guarantees you income for the rest of your life, right? So take stock of your situation, your personal situation, and look at how you can get out of paying taxes. Do it through a trust, right? And then let it issue you planned payments over a period of time. Now your money is protected from what? From who? Creditors, from you if you have bad decision making, right? And things of that nature. So it's a lot of different things. Lawsuits, just a lot of different things that you can use that money in that trust to protect you from. Probate, I mean, just on and on and on. So many things that it can protect you from, even family members. So I hope this video has added some value to you. If it did, be sure to hit that like button, and I look forward to sharing it with you on the next video. Meantime, take care of yourself and each other.